New highs for stocks by mid-2024, says JP Morgan's Stephen Parker. With an eye on the Middle East and specifically the oil markets, the outlook for earnings in the equity markets seems to re-accelerate, which could cause new highs by the middle of 2024, said Stephen Parker, head of specialized strategies at JP Morgan Private Bank. In a CNBC interview on Tuesday, Parker and Mary Ann Bartels, Sanctuary Wealth's chief investment strategist, agreed that in the current higher-for-longer rate environment, rates have reached an intermediate top, actually benefiting equity markets. What could potentially negatively affect the markets, said Bartels, is if crude oil prices could break above $100. Higher crude oil prices hurt earnings, and at the end of the day, that's what the market is going to respond to. But it's also going to hurt the consumer, she said. In addition, Treasury yields opened sharply lower on Tuesday, with the 10-year slipping to the lowest level in a week. I think the knee-jerk reaction was geopolitical, said Parker. But I think that the Fed speak is what's going to ultimately drive the direction of rates. The Treasury ETFs rallied early in the week after the news broke of the Israel-Hamas war. But it was really the dovish comments that you saw from some of the Fed speakers that got that rally to really kick into gear in the second half of the day, he added. On the equities market, he said, history gives us a pretty clear roadmap on geopolitics and the impact on markets. Markets, he explained, quickly tend to pivot back towards fundamentals. Depending on the stability of the oil markets, the shift would be back to the Fed and this season's earnings coming up. Our view is that the earnings outlook looks good, Parker said. We think we bottomed out last quarter, we began to re-accelerate, and the fundamental story is a good one, which is supportive of stocks. He said he believes there will be a soft landing, with growth next year decelerating but not to the point where there is a major recession. The new highs in the market next year, he believes, will be largely driven by earnings growth, not by valuations, although the sell-off recently has given us a little bit more cushion on the valuation side. Bartels added that the ISM manufacturing data is improving now. We're not above 50, but it looks like manufacturing has actually bottomed. Inventories are low, they're going to have to be rebuilt. And prices paid are actually falling, so it's really a positive mix, which should help boost earnings and margins. As long as crude oil doesn't spike higher and stay higher, she said. Parker also said he believes that the pullback is an opportunity and that he likes industrials because of the long-term policy support for that sector. He also recommends looking at equal-weighted S&P exposure and mid-cap names. We know that a lot of the rally this year has been driven by the Magnificent Seven, Nvidia, Meta, Amazon, Microsoft, Apple, Alphabet, Tesla. He said, but we think there is a catch-up trade more broadly across the market. So we're moving down the capitalization spectrum a little bit, not all the way down to small cap because higher rates have a bigger impact there. Tech, in addition, continues to lead the market with its array of mega caps, but what we're looking for is a little bit of a rotation in terms of market leadership, away from the concentrated leadership of the mega cap tech story to some of the broader parts of the market, he concluded. We've really been focused on semiconductors and software and services, said Bartels. I would also agree that industrials are the emerging leadership, and we also continue to like energy stocks.